Let's go ahead and talk about intercompany sales of inventory. Intercompany sales of inventory, and again we're talking about inventory which is destined for eventual resale to some third-party customer. When a parent sells inventory to a subsidiary, or a subsidiary sells inventory to a parent, or one subsidiary sells inventory to another subsidiary, our job is to make it appear as though the sale never happened. As always, our consolidated financial statements should only reflect transactions with and relationships with external entities. All transactions within the consolidated entity need to be eliminated in the preparation of the consolidated financial statements. Now, in all of the examples that follow, let's assume that the intercompany sale of goods is made at a profit, so we can refer to the unrealized profit instead of unrealized profit or loss, and we can refer to marking up the inventory rather than referring to marking up or marking down the inventory. When an intercompany sale of inventory occurs, the gross profit on that sale is unrealized. The gross profit gets realized when the inventory is ultimately resold to some third party. Let's go ahead and think about this as in comparison to, or as an analogy to, the intercompany sale of land that we talked about earlier. When a company had an intercompany sale of land, the gain or loss on the sale of land needed to be eliminated, and the land needed to be reduced to its true historical cost each year in the elimination process. In the case of inventory sales, it's a similar process. Instead of having a single gain on sale of inventory account to eliminate, we're going to have sales revenue and cost of goods sold. By eliminating the sales revenue and the cost of goods sold, we thereby eliminate the gross profit. Similarly, in the case of the intercompany land sale, for as long as the purchasing party owned that land, every year in the elimination process we had to reduce the land back down to its true historical cost. And the same thing will apply here. We now have this inventory which has been marked up in the sales process, and for as long as that inventory is held by the related party, we're going to have to reduce their inventory down to its true historical cost. In the case of the intercompany sale of land, when the land was eventually sold to some third party, it was at that point that we said the gain has been realized and we can go ahead and recognize it. And it will be the same thing in the intercompany sale of inventory. When that inventory is subsequently resold to some third party, then we can go ahead and recognize the previously deferred gross profit on that sale of merchandise. Now, in the year in which an intercompany sale takes place, there are three aspects of the transaction that need to be eliminated. First, we have the intercompany sales revenue. The intercompany sales revenue has to be eliminated. If we didn't require this elimination, firms could increase their sales revenue without limit simply by selling goods back and forth between the parent and the subsidiary over and over again. By the same token, we have to eliminate the intercompany cost of goods sold. And again, by eliminating these two accounts, by eliminating sales revenue and eliminating cost of goods sold, we're thereby eliminating the gross profit from the consolidated income statement. Third and finally, somewhere in our accounting system, there's some merchandise which has been written up as part of the sale. And just to have some concrete numbers to refer to, let's assume that Big had some goods which cost $7, which they sold to Little for $10. That merchandise, which has a true cost to the combined entity of $7, is now in Little's accounting system at the inflated or written up cost of $10. That merchandise and that inflated value is in one of two places. If Little still holds the merchandise at year end, then that inflated value is in inventory, and we're going to have to correct inventory by writing it down from $10 down to $7. If that merchandise has been sold, then that inflated value has moved from inventory to cost of goods sold, and we're going to have to correct cost of goods sold, reducing it from $10 down to the true cost of $7. So that means that as a final adjustment, we're going to need to either adjust inventory or cost of goods sold. Let's go ahead and run through a quick example. Let's assume that Big owns 100% of Little, and on January 1st, 2001, Big sells inventory to Little for $10,000. The goods had originally cost Big $8,000, So there's a $2,000 gross profit on this sale. And first on Big's books, they're going to go ahead and record the sale of the merchandise, and we'll assume it's a cash sale just to keep life simple. And assuming a perpetual inventory system, they'll record $8,000 of cost of goods sold as well. So on Big's income statement, they've got sales revenue $10,000, less cost of goods sold $8,000, gross profit $2,000. And again, that gross profit is unrealized because it was a related party transaction. It was sold to Little. On Little's books, they record the purchase of this merchandise for $10,000. And so again, we see that the inventory has been inflated or written up by that $2,000 gross profit. The true cost of the goods is $8,000. It's currently sitting on Little's books at $10,000. So we've got this inflated inventory value that's sort of messing up our accounting system. Now, first, let's go ahead and assume that Little Company resold all this merchandise to some third party in 2001, and let's say they sold it for $11,000. Now, the price they sold it for to that third party is irrelevant to the elimination process, but it's nice to have a concrete number to point at and talk about. Now, since the goods were resold to a third party, that means that the earnings process has been completed, the profit on the intercompany sale has been realized, and that inflated merchandise is no longer in our accounting system. And does that mean that we can simply leave this alone since there's no unrealized gross profit to eliminate? And the answer, of course, is no. We still have to eliminate the intercompany sales revenue, we have to eliminate the intercompany cost of goods sold, and we're also going to have to fix the cost of goods sold that Little is reporting, because again, Little is going to report cost of goods sold of $10,000 when they sell this merchandise. Now, let's go ahead and envision what the consolidation worksheet would look like for Big and Little, and to make this clearer, let's assume that this intercompany sale from Big to Little and then the subsequent sale from Little to the third party were the only transactions that Big and Little engaged in during the year. So here is the top part of our consolidation worksheet. And again, we see that Big has sales of $10,000, less cost of goods sold of $8,000 for a gross profit of $2,000. Little took that same merchandise, sold it for $11,000. Little's cost of goods sold is $10,000, so they're showing a gross profit of $1,000. And if we simply added them across, we'd have, sales revenue 10,000 plus 11,000, 21,000, cost of goods sold 8,000 plus 10,000, 18,000 for a gross profit of 3,000. So we have the same gross profit, but again, the problem is we're, in a sense, almost double counting sales revenue and cost of goods sold. The intercompany sales revenue, the revenue that Big had from the selling to Little has to be eliminated, and Big's cost of goods sold has to be eliminated as well. Now, since the sale from Big to Little never happened from a consolidated standpoint, we need to eliminate Big's sales revenue and their cost of goods sold as well. So we debit sales revenue for $10,000, we credit cost of goods sold for $8,000. Now clearly there's $2,000 missing in this entry. There's a $2,000 credit that's missing. And again, this represents the gross profit which was embedded in the merchandise when Little bought it. Again, it was written up from $8,000 up to $10,000. And where that merchandise is, whether we still have it or whether it's been sold to some third party, will dictate how we need to go ahead and handle this elimination. Now, since the goods were actually sold to a third party, again, Little's recording cost of goods sold of $10,000, the true cost was only $8,000, so we have to reduce cost of goods sold by $2,000 to get it down to its proper level from $10,000 down to $8,000. Now clearly we could, simplify this entry combining the two credits to cost of goods sold, so a debit to sales revenue for $10,000, a credit to cost of goods sold for $10,000. So we plug that into our worksheet, and again, now we have the correct totals. We had an 11,000, again, the consolidated column in that worksheet at the top of the page represents our transactions with external third parties. We had one sale to an external third party for $11,000. That was the goods that Little sold to that third party. And we have one cost of goods sold that arose from a transaction with a third party. Big bought that merchandise from some other supplier at a cost of $8,000. Now there are a few things to note about this. First, this had no effect on income. In the worksheet, we have $3,000 of gross profit. The elimination entry, the $10,000 debit to sales and the $10,000 credit to cost of goods sold, clearly is a wash as far as income is concerned. We reduced sales, we reduced expenses both by $10,000. This has no effect on income because we didn't have to defer any profit. The goods were sold to a third party, the unrealized profit was realized and recognized, so we didn't have to defer any of that gross profit. Again, Big showed a $2,000 profit on their sale to Little, and we let them recognize the whole thing because the earnings process had been completed. And finally, since the inventory has been sold, it's no longer on Little's balance sheet, so its valuation doesn't need to be corrected. There's no unrealized gain at the end of the year to worry about. It's all been realized and we're done. We can walk away. Now let's go back to the original way we set up that elimination entry, keeping the two credits to cost of goods sold separate. Again, we have to eliminate the intercompany sales revenue with a debit. We have to eliminate Big's cost of goods sold with an $8,000 credit, and we had to correct Little's cost of goods sold by reducing it by $2,000 from $10,000 down to $8,000. Now, what if the goods had not been sold? What would change? What would we have to record? We still have to eliminate the intercompany sales revenue, so we debit sales revenue for $10,000. We still have to eliminate the intercompany cost of goods sold. Again, Big's cost of goods sold is $8,000. That wasn't a transaction with a third party, so we have to get rid of Big's cost of goods sold. Finally, the difference, that $2,000 markup, now instead of being sold and having that marked up value embedded in cost of goods sold, if Little still holds that merchandise, that means that their inventory is overvalued, inflated, or marked up. And so what we're going to have to do is adjust Little's inventory value to get it from $10,000, the inflated value, down to its true costs of $8,000. Now, what if some of the goods have been sold and some are still unsold? Well, in that case, things get a little bit more complicated. Again, we have this $2,000 gross profit, this $2,000 markup on this inventory, and basically that inventory is either still on hand, or it's been sold, or some of each. And what we have to do is adjust both cost of goods sold and inventory appropriately to reduce those to their correct values. So again, no matter what, we have to eliminate the intercompany sales revenue, and we have to eliminate the intercompany cost of goods sold. So we do that. Now, again, what's left? The missing $2,000 in the entry taking shape below is the markup, or the gross profit, which was embedded in the inventory value. If the goods have been sold, we have to strip out that markup from cost of goods sold. If the goods are still in inventory, we have to strip out that markup from inventory. If some are sold and others aren't, we have to adjust both cost of goods sold and inventory. Let's go ahead and assume that of the $10,000 of merchandise that was sold, 1/4 of that is resold, which means that 1/4 of the gross profit has been realized, while the other 3/4 has not been sold. So the other 3/4 of that $2,000 gross profit has not been realized. So of that $2,000 markup, 1/4 or $500 has been transferred to cost of goods sold, and we need to fix cost of goods sold, so we reduce cost of goods sold by $500. Similarly, the remaining 3/4 or $1,500 of that markup, or that inflation, is residing in inventory, and so we have to correct inventory, reducing it by $1,500. So again, this is the entry we just left off with. Now, instead of doing this one entry, as is probably apparent by now, I like to break things down into discrete steps. Let's go ahead and break this into a 3-step sequence, because again, it can get a little confusing when you have some merchandise being resold and others not being resold. So that entry could get a little convoluted. So if we break it down into bite-sized pieces, it's usually easier to follow through the process. Our first step is going to be to eliminate sales and cost of goods sold in the amount of this year's intercompany sales revenue. So we'll go ahead and debit sales for $10,000, and we'll also credit cost of goods sold for $10,000. And again, this entry has no effect on income. We're reducing sales revenue and cost of goods sold both by $10,000. Now, this is exactly what we did when we assumed that all the merchandise had been sold to some third party. We said, look, the gain has been entirely realized. There's not going to be any effect on income. We're not going to defer or eliminate any unrealized gain, we're going to go and recognize the entire profit. Then we step back and say, okay, that first entry would be what we would have done had all of the merchandise been sold to some third party. Now we step back and ask, has all that profit been realized? Is there any merchandise that hasn't been sold yet? And if so, step 2, we're going to go ahead and defer any unrealized gross profit from this year's intercompany sales. And again, in the example we've been working with, we assumed that 3/4 of the merchandise has not been sold yet, which means that 3/4 of the gross profit is unrealized and has to be deferred. We're going to defer that $1,500 by increasing cost of goods sold and decreasing inventory by the same amount. So we're killing two birds with one stone here. With the debit to cost of goods sold, we're reducing our income, we're deferring the unrealized profit. With the credit to inventory, we're writing the inventory down to its correct level. Now, these two entries, the step 1 entry and the step 2 entry, if you combine those together, we get the entry at the top of the page. So we're getting to the same place, we're just taking sort of a step-by-step approach to get there. Now the third step would follow in the following year. Just to recap where we left off, Big sold goods costing $8,000 to Little for $10,000. 3/4 of these goods were still unsold at year end. They're on the books at $7,500. That's 3/4 of the intercompany selling price. Their true cost is $6,000, 3/4 of the true total cost of $8,000. So that $1,500 difference, $7,500 versus $6,000, that $1,500 difference is the markup or the inflation or the profit that's embedded in the inventory account. And again, think back to the intercompany sale of land example. When the company that acquired the land in the intercompany transaction carried that land forward from year to year, we said we were carrying forward an unrealized gain on that transaction. And the same thing's happening here. We have two problems. They're both sides of the same coin. Big has this $1,500 gross profit on their income statement last year that wasn't realized. And secondly, Little has this inflated inventory on their balance sheet. That inflation or markup is equal to the remaining unrealized gross profit on the intercompany sale. So step 3 is going to involve carrying forward this unrealized gain to the following year and dealing with that inflated inventory, basically addressing these two problems that we have. Now this was a downstream sale, so the non-controlling interest isn't affected by this. And let's assume that Big uses the partial equity method. That means that last year, when we had this intercompany sale, Big didn't adjust their investment income to take away that unrealized gain. And so basically Big's retained earnings was overstated. They reported too much income last year on their individual income statement. So we need to fix the retained earnings and say, look, they've got this unrealized gain from last year. Their beginning retained earnings is too high. We need to go ahead and reduce the retained earnings by $1,500. So we debit retained earnings for $1,500. The second problem is that Little had this inflated or overvalued inventory on their balance sheet at the beginning of this second year. Now if it's still on hand at the end of the year, then we have to reduce inventory down to its correct level again. If the goods have been sold in this second year, then that inflated inventory value has been transferred to cost of goods sold, and we have to correct cost of goods sold. If some of the goods have been sold and others still haven't, then we'll have to adjust both inventory and cost of goods sold. Now, in all of these examples, we'll assume for simplicity that we're going to use a FIFO inventory flow. That means that basically, in most cases, whatever was unsold at the end of this year will be sold the following year under a first in, first out inventory flow. If this was LIFO inventory, then we'd have LIFO layers involving intercompany sales of inventory, and it would just get convoluted beyond measure. So to summarize our three-step process, step 1, eliminate sales and cost of goods sold in the amount of this year's intercompany sales revenue. Step 2, defer any unrealized gross profit from this year's sales by increasing cost of goods sold and at the same time reducing inventory to remove the gross profit from inventory. So we debit cost of goods sold and credit inventory. And then third and finally, we carry forward any unrealized gross profit from previous years and deal with that overvalued inventory accordingly. Again, either correcting cost of goods sold and or correcting inventory. Now, just to make this as generic as possible, on the debit side, when we carry forward that unrealized gross profit, we would debit either retained earnings or the investment in subsidiary account, depending upon whether the parent is using the full or the partial equity method. And if it was an upstream sale, we'd also debit the non-controlling interest. This is identical to what we would do in the case of the intercompany sale of land or the intercompany sale of a depreciable asset. On the credit side, again, we've got this overvalued inventory that was in the acquiring company's accounting system at the beginning of the period. And again, if that merchandise has been sold, then that inflated merchandise has moved on to cost of goods sold, and we have to fix cost of goods sold. If it hasn't been sold, then that inflated merchandise is still residing in inventory, and we have to fix the inventory account.